advance estimate. Now it is 9.2%. We will have one more estimate before these numbers are frozen. And the second advance estimate for FY25 is 6.5%, up slightly from 6.4, which the Ministry of Statistics had projected earlier. And this is partly on the back of slight upward revisions to the growth rates for the first 2 quarters. And I will speak more about the prospects for reaching 6.5% growth rate in FY25 as we go along. The right-hand side shows you, of course, that as far as the full financial year is concerned, please note India has a April to March. Other countries have calendar year basis, but nonetheless, since 9 months of calendar year 24 are covered in the case of India, we are comparing the CY24 growth numbers for other countries compared to India, where our growth rate continues to stand out among peer groups, both in advanced and developing economies. Next slide. So what we show here is that the nominal GDP growth rate, this is very important because these revisions, and by the way, Ministry of Statistics, I'm grateful to them for giving the explanations also as to how these revisions happened and underlining the reasons based on additional data sets being available to us in the course of the last 3-4 months, which is what has led to the upward revision for FY23 and FY24. So what you see here is that India's nominal GDP growth in FY22, I think hit about 18.9%, as you see in the purple line, reaching almost 20% in FY22, 18.9 it was. 14% in FY23, 12% in FY24, and 9.9%. So in a way, when we saw the tax revenue numbers for the previous years, the buoyancy rates appear to be unusually large, but the revision to nominal GDP growth rates suggest that the tax buoyancy rates were normal and reasonable because we had undercounted the GDP growth in the previous years, and these revisions actually lend more perspective and balance to the tax buoyancy and GDP growth numbers, which we also saw in the gains to corporate earnings and asset market performance. So there is now a better congruence between GDP numbers, tax revenue, asset market performance, corporate earnings growth, etc. So we have 18.9, 14, 12 and estimated 9.9% nominal GDP growth for FY25. And when it comes to real GDP, repeating myself, 9.7 in FY22, 7.6 FY23, 9.2 FY24, and projected 6.5% for FY25. Next slide, please. And by the way, the nominal GDP estimate for FY25, which happens to be around 331 lakh crores or 331 trillion rupees, roughly translates into, based on the average estimate for the exchange rate that we have for FY25 up to February 27th. This is based on the daily average exchange rate, and if you divide the 331 trillion rupees projected rupee GDP in nominal terms by the average exchange rate, which boils down to 84.37 paise for FY25 up to February 27th, we get a number of $3.924 trillion, which is quite close to the $4 trillion for FY25. So the economy is on the verge of crossing the $4 trillion GDP by FY25 itself. Falling slightly short, but it depends on the exchange rate as well in the coming days. Next slide, please. Before we move on to the next slide, I'm sorry, please stay here. Please go back to the previous slide. Thank you. The nominal GDP composition, which is the primary sector, this year in FY25, as you would have seen from the MOSPI press release, primary sector did well, and naturally, given the slowdown from 9.9, from 12% to 9.9 in terms of nominal GDP, other sectors have seen a slight reduction in especially the secondary sector, and the tertiary sector has held its ground and increasing slightly in the overall share of GDP. Broadly speaking, as you can see on the right side, growth rates in secondary sector is sharply down, and the primary sector is up from 2.7, which is largely agriculture, and services sector has held its own. Next slide, please. Real GDP growth has rebounded both in the first and second quarter. The GDP numbers have been revised slightly higher. Now, for the third quarter, which is October to December, the Ministry of Statistics, I beg your pardon, has estimated 6.2%. So some of you will be obviously doing your math and trying to figure out how we get to 6.5. It requires, of course, a 7.6% annual growth, year-on-year growth in Q4 compared to Q4 of FY24. Now, you might wonder, how is it possible that from average growth performance of around 6%, 6.1% maybe, in the first three quarters, if you want to hit 6.5, one needs to achieve something like 7.6%. Now, that is where I would like you to note three things. One, the good performance of exports, basically both merchandise, non-petroleum, non-gems and jewelry, which is almost rising at 10% rate for the entire April to January period. I'll come to that later. The second indicator I want you to keep in mind is the fact that public sector or union government capital expenditure, if you look at the financial accounts of the union government released also today, you can see that capex for the current financial year up to end of January is very much in line with the expenditure incurred in the previous financial year. Almost 75% have been expended as of end of January, which is the same as the number or slightly lower than the amount spent in the last financial year. So the capex, government capex, after the initial slow start because of election, has really picked up steam in the fiscal third quarter, coming into the fiscal fourth quarter as well. The third dimension, which makes the 7.6% realistic, is the huge spending that has happened in January, spilling over into February, associated with the Mahakumbh, where a huge 50 to 60 crores of people have visited and spent additional sums of money, and this can also add to nominal to GDP quite significantly from the expenditure side. So in that sense, the implied fourth quarter GDP growth number of 7.6% doesn't look that unrealistic. And even in the October to December quarter, India's GDP number, while on the lower side compared to its previous 3 years of data, it is still performing much better than many other peer group economies, as you see in the right hand side. Next slide, please. In terms of growth rates, agriculture, the primary sector, as I said, has really gathered momentum on the back of a good monsoon, and rural consumption data also back up this growth in the primary sector. Industry is also recovering, and services sector is maintaining its high growth rate. So in general, the three sectors of the economy are doing well. There is no lopsided dependence on one particular sector. And if you look at export growth, as I just now mentioned, if you look at the data for the entire month of April to January, non-petroleum, non-gems and jewelry exports is up 9.7%. And imports are up, non-petroleum, non-gems and jewelry imports are up only 6.6%. And services exports, imports, and therefore services sector trade surplus are all growing somewhere between 14 to 15%. Exports are up 14.5%, imports 14.8%, and therefore services sector surplus is up 14.2%. I am referring to the April to January period of FY25 compared to April to January period of FY24. So we have actually this financial year, exports are also contributing to output growth in the economy, and investment rates are picking up, as I will show you later. Next slide. What are the current emerging trends? Next slide, please, in the economy. Okay, so now while we have looked at the previous year's numbers and put them in context, looking ahead, talking of 7.6% implied growth rate in the fourth quarter that we need to achieve to get the annual figure of 6.5, manufacturing PMI is continuing to expand, and services sector PMI, which is not shown here, is also in strong expansionary territory, and uptick in the growth of index of industrial production and the 8 core sector industries as well. Significant growth in e-way bill generation, year-on-year growth rate is again accelerating, which is also a good sign of goods movement, and therefore suggesting robust economic activity, as you can see in the bottom chart in this slide. Next one, please. Thank you. So services sector PMI remains very steadily in the expansionary zone. Digital transactions are rising. I mean, the scale effect should not obscure us to the fact that they are growing. The volumes are in billions of transactions, and values also heading towards 20 lakh crores. Hotel occupancy rates, after a slump in the October quarter, is now back to the usual average in the last 2 years of around 70%, which is at the high side compared to, let's say, February 24 and December 23, etc. So that augurs well. And double-digit growth in air cargo, which is on the right scale, and port traffic, which is captured on the left scale on the bottom right chart here. Both of them double-digit growth in air cargo and port traffic also indicates both good external activity as well as internal trade within the country. So that is a good sign. Next slide, please. When it comes to domestic demand in particular, and focusing on urban demand, FMCG volume sales, volume doubles in terms of the growth rate, year-on-year growth rate was very low at 1.9% and 2.6% in the first 2 quarters. Now that growth rate has quite strongly picked up, almost doubling in Q3 compared to Q2, or almost more than 2.5 times compared to Q1 rates. And domestic air passenger traffic handle is definitely shifted levels up compared to FY23 and FY25, growing in double digits compared to the previous years. And passenger vehicle sales has also been rising in the course of the current financial year, as you see in the bottom chart. Next slide, please. When it comes to rural demand, it has been resilient, both the two-wheeler and three-wheeler sales. Based on the data for the first 10 months of the financial year, you can see a steadily rising trend in the far left chart. Tractor sales in the middle, matching the highs we saw in FY23, consistent with the fact that the primary sector has done very well. And then we saw overall volume growth, especially pertaining to rural demand. We saw in the previous slide for urban India, this is for rural India, the growth rates are at 9.9% for FMCG sales in rural India in the third quarter. So overall, I think we are talking about urban and rural demand doing quite well. Urban demand picking up from a slow beginning of the financial year, and rural demand maintaining its growth rate and accelerating further in the third quarter. Next slide, please. Inflation rates are trending down after seasonal volatility in food inflation. Now it is coming down to converging with the headline and core inflation rates. Overall, I think by and large, as we have been reiterating in the course of the financial year, including in the economic survey, headline inflation rates were distorted by a few items related in food area, in the food category, and as well as the increase in the prices of gold and silver. Next slide, please. We spoke already about the performance of the external sector. This year, it's been core merchandise, means excluding non-petroleum and non-jewelry and gems. We talked about 9.7% growth in the current financial year. And same is the case with respect to services and forex reserves. While they have come down from the peak, overall, they are still good to cover 10 months of imports, which is a very comfortable situation. So we don't see external sector vulnerability at this point. And next slide, please. FDI flows, I think the important point to note here is that while repatriations have jumped by about $10 billion in the current financial year based on RBI data, which is available up to December, April to December 24-25, compared to April to December 23-24 financial year, the outflows have picked up from $33 billion to $43 billion. At the same time, inflows have picked up from 51.8 to 62.5, also picking up by about $10 billion. Little more than $10 billion, if I may say so. So in that sense, there is continued active interest from investors in India, new investment. At the same time, legacy investors have been using the extremely buoyant Indian stock market until recently to generate profits on their old investments, and some of them going into the hands of portfolio investors from PE and VC investors. So that is why on a net basis, you see very little change. At the same time, overall investments this year, both FDI and FII, you can look at the RBI data, are on the lower side. But it has been very well offset by improved performance both with respect to remittances, for which we don't have the data here, as well as good performance on the export front. And that is why the current account deficit is small, which therefore financing it continues to pose no challenges as far as India is concerned. Notwithstanding, and let me remind our audience here today that the trend in FDI numbers is not peculiar or unique to India. The trend in FDI numbers is very much related to the global phenomena where onshoring and friendshoring, in fact, even friendshoring is giving way to onshoring and FDI flows. And we have discussed this in the economic survey as well. So that is why India's current account deficit, where it is today between 1 and 1.2% of GDP for the current financial year, is eminently in the comfort zone, given the kind of uncertainties and risk aversion that will continue to be with us when it comes to FDI flows for the coming financial year as well. And FPI flows, because of profit taking, the Indian stock market went almost parabolic between July 24 and October 2024, and those parabolic gains are now currently being unwound in the marketplace, and part of it is either due to or because either due to the FPI flows or FPI outflows or a consequence of this. So there is a two-way relationship between the two, and as we speak today, we notice that the US stock market is significantly down, and the Indian market today has reflected that as well. But as a recent commentator, one of the long-standing observers of the Indian market, Mr. Chris Wood of Jefferies, earlier he used to be in CLSA, and he has said that from a long-term perspective, he continues to remain very positive on Indian stocks, and the growth numbers we have seen, including the revisions to previous years, validates the point he makes, which is about the long-term attractiveness of the Indian market at this stage. Notwithstanding recent volatility, which is partly driven by global developments and also partly driven by stellar gains of the previous years. Next slide, please. The central bank in the last 2 months or so has been unwinding some of its unintended monetary tightening and also credit tightening that happened in the course of the current financial year. In fact, starting from the previous financial year, not only have we witnessed a reduction in the repo rate and the cash reserve ratio, and also the higher risk weights which were mandated in November 2023 when uncollateralized, unsecured consumer loans where risk weights were restored to the pre-COVID levels. But now that these loans have growth rates have come down, RBI has withdrawn the increase in risk weights mandated in November 2023. So the non-food credit growth, which was 17.1% in FY23, at the peak is now at 12.4%. But considering the nominal GDP growth of 9.9% projected this year and 12% last year, non-food credit growth is not trailing nominal GDP growth, and that's a good sign. Next slide, please. In terms of outlook for capital formation, which is what we turn to next. Import of capital goods has been steadily rising, and that is the share of capital goods in total imports is about 20% compared to a figure of around 17 to 18% in FY22 and FY23. And the production of infrastructure and capital goods in the 3 quarters of the financial year compared to the previous financial years, whether it is capital goods or infra construction goods, you can see a steadily rising trend, which augurs well also for capital formation. Next slide, please. Private investment intentions after a dip in the first quarter due to election-related uncertainties in India, and therefore they are again picking up in Q2 and Q3, as this chart very clearly demonstrates. This is the value of new projects announced by the private sector. Next slide, please. And also, if you look at the labor market, unemployment rate is down to around 6%, and the labor force participation rate is comfortably above 50%, and we are seeing a steadily rising net payroll additions based on EPFO records. So after a dip in the first 2 quarters of the financial year, this is also in a way consistent with the improvement we are seeing in the GDP trajectory and the projected implied growth rate in the fourth quarter as well, fiscal fourth quarter. Next slide, please. Overall trends in savings and investment, we spoke about capital formation in earlier, both in the government sector and in the private sector, in terms of the increase in production in capital goods, infra goods, import of capital goods, etc. We will go into them a little bit more detail on trends in savings and investment in this section. Next slide, please. So what you see here is that when it comes to private non-financial corporations, now that MOSPI has given us data until FY24, so from 7.2 lakh crores to 28.7 lakh crores in the last 12 years. That's a 4x growth. And gross capital formation, because the second decade was about using these improvement in savings to restore balance sheet health, corporates gross capital formation, as you can see here, was at its low point, somewhere closer to the low point in FY21, and since then has been picking up, but still overall it has picked up 3x. So corporate savings had indeed grown faster in the last 12 years compared to the capital formation, but we know that for the bulk of the second decade, this was mainly due to balance sheet repair. Next slide. If you look at in general, the gross fixed capital formation at the economy level is around 30%. So there is room for private sector to invest. Of course, there is uncertainty globally, but uncertainty isn't there with respect to Indian demand. Urban demand is recovering, and the government in the budget for FY26 announced a significant tax cut for middle class, which leaves a lot of purchasing power in their hands, contributing to aggregate demand. And we're also seeing that outbound FDI by Indian companies, if you look at the RBI data, outbound FDI by Indians has picked up by about $7 billion in the course of the current financial year compared to the last financial year up to December. So in fact, it is a bit of a paradox that uncertainties elsewhere isn't really coming in the way of the Indian private sector increasing its outbound FDI, and therefore all the more reason for the Indian private sector to invest in a country whose current growth record exceeds the growth performance of other economies, and also whose prospects for continued growth at this rate at the minimum of 6.5% is much better than it is elsewhere. So I think there is a case, a very good economic case for the private sector in India to ramp up its capital formation so that the rate of capital formation to GDP rises from 30% towards the mid-30s. If you look at the private sector in a more granular way, its investment in machinery and equipment after declining in FY20 and FY21, it has been rising. Of course, there are some, you can see that the deflators used in FY20 FY23, and the Ministry of Statistics officials tell me, and some of them are on the call, so in case there are some questions, the ADG, Mr. Sanjay Sinha, is on the call. If you notice FY23, the growth rate of private non-financial corporate sector investment in machinery and equipment went up nearly 20% on the back of a very strong growth in FY22. But in real terms, it is very low. So we do have, so in that sense, some of these data, we need to look at them in nominal terms, because the deflator may be distorting the numbers we are looking at in real terms. Such a problem doesn't arise when we look at how far the private non-financial sector has been investing in intellectual property products. On the bottom right, you can see that the growth rates are around 10%, while it is distorted by some very high growth numbers in the earlier years. So overall, I think the private sector non-financial capital formation has been picking up, but there is room to do more given demand visibility in India compared to elsewhere in the world. Next slide. If you look at the overall gross savings ratio, they have picked up from the lows of FY20 and 21 which were below 30%, but now they are at 30.7% on average. In the last 3 years, it's been around 30 and 31%. And as the corporate sector invests, and with more disposable income in the hands of the public, given facilitated by the tax cuts and hiring trends which are indicated by the EPFO net payroll addition numbers, higher employment growth and income growth will result in higher household savings, which are now on the slightly on the lower side compared to historical trends. The share of savings of the private sector is again higher, even though in the last 6 years it has been somewhat steady around 35% compared to historical trends. It's on the high side. We saw earlier gross savings went up by 4 times in the last 12 years for private non-financial sector compared to gross capital formation, which went up by 3x in the last 12 years. So that is now a good case for the private sector to put its accumulated savings to use and generating a virtuous cycle of demand growth, employment, income, and more consumption, etc. Next slide, please. So overall outlook, the near-term global economic outlook is of course influenced by policies followed by countries. There is both geopolitical and geo-economic churn as we speak. But I think we should not be held hostage by uncertainties in general, because they are going to be with us for quite some time globally. And therefore, within the context of overall uncertainty, India happens to be one geographical entity where these uncertainties are relatively lower. The balance sheet repair of the second decade, the post-COVID recovery are well cemented. And in fact, I would urge some of you to take a look at the more granular tables that the Ministry of Statistics puts out, in particular, statement 3.1b of the Excel sheets that the Ministry of Statistics puts out very helpfully. If you look at the gross capital formation to output ratio of several sectors, and I would like you to spend some time on it, they augur well for future growth, because in general, the GCF to output ratio is the inverse of what you might call the incremental capital output ratio. So, or the way rather, it is the equivalent of the incremental capital output ratio. So when the GCF to output ratio goes down, which means it is good, we are able to generate more output per unit of investment or capital formation. So the gross capital formation or GCF to output ratio in 9 or 10 specific sectors disaggregated is given in statement 3.1b. And in those sectors where this ratio has risen in the last 2-3 years, especially post-COVID, And you can see that in the other services, transport and communication, or even in mining, in utilities, electricity, the ratio has gone up. Then you might wonder why the ratio has gone up. Have these sectors become more inefficient? That is where I want you to pay attention to the underlying data. The ratio has gone up because the capital formation numbers have gone up in these sectors, and that augurs well for output growth in the coming years as these investments begin to generate output. So I think that's a good sign for future growth, as well as the investments made post-COVID in these sectors begins to generate output in the coming years, and that is why we are comfortable projecting a growth rate of 6.5% on average in the coming years in real terms, and somewhere between 10.5 to 11.5% in nominal terms in the coming years. Now, obviously, export performance this year, non-petroleum, non-gems and jewelry, has been quite good in comparison to previous years, but obviously not in comparison to FY22 or in the first decade of the millennium, when export growth was contributing 40% to GDP growth every year. Now this average has come down to about 20% contribution from exports, but that is the nature of the game, because there is uncertainty and there are trade restrictions as countries impose both tariff and non-tariff barriers on each other. So that is why, on the strength of the domestic demand, on capital formation and output growth, we will be able to grow at 6.5%. But there are some risk factors, which is restrictive trade policies, which can both contribute to inflation and lower export growth, apart from stock market volatility. And dollar strength and rising Japanese interest rates could also exacerbate capital flows from emerging economies in general, not particularly specific to India, and therefore we need to be on guard with respect to the overall sentiment and rising risk aversion affecting financial market conditions more than affecting the real economy in our country. But despite these uncertainties, which I said will be with us for quite some time, our India's economic momentum is expected to sustain, driven by strong rural demand and recovering urban demand. Robust kharif production and better rabi sowing, coupled with higher reservoir levels, continue to augur well for output growth and GVA growth in the primary sector being better than the previous years. And the union budget's emphasis on agriculture, MSME investment and exports, apart from the big boost it has given to middle class purchasing power and consumption demand in the form of tax cuts, are also likely to contribute positively to medium-term economic prospects. As I said, sustaining this growth rate will be further strengthened if the private sector were to ramp up investments without being influenced by global uncertainties and focusing on the lesser uncertainties and greater certainty with respect to the Indian economy and Indian economic growth. That's all from my side. Thank you very much, and we can take a few questions.
Thank you so much, sir, for your informative briefing on the state of the economy and the growth prospects. Now we move to the question and answer session. So the first question by Prashant Sahu from Financial Express. Prashant, kindly go ahead and ask your question.
Sir, do you think the implicit GDP growth of 7.6% in Q4 this year is slightly on the higher side, given the global uncertainty surrounding merchandise exports and commodity prices, which could affect corporate margins, as well as subdued prints for sectors such as electricity and coal for January?
Yeah, thank you, Mr. Sahu. I think your points are well taken, but these have been with us in the third quarter also. But incrementally, at the margin, I listed three factors which were likely to justify the implicit assumption of 7.5% in my initial remarks.
Next, Kriti Ambe from Informis Media.
Hello, sir. Good evening. Good afternoon, since you are in Cape Town. You mentioned that currently you do not see global uncertainty posing a major risk to the Jan-March growth. But the dynamic is going to change significantly in April when US rolls out its reciprocal tariffs. So, would you be able to share your initial thoughts on how do you see it affecting the Indian economy, and what would be the safeguard measures that could be taken to avoid a significant impact of that? And also, last quarter when we had this press briefing, you had mentioned that the slump in Q2 growth was on account of hit to manufacturing sector. That was because of dumping, because other elsewhere economies had overcapacity. Now, US has already started imposing higher tariffs on China. So, do you expect a situation of dumping affecting the manufacturing sector growth, a situation like that evolving in the coming in this fiscal year as well, and going ahead in the next fiscal year?
Okay, thanks. Yeah. I get that. I think first of all, the reciprocal tariff, etc., is at the moment, as far as India is concerned, it's speculative. Since we had the last quarter GDP conversation, the Honorable Prime Minister of India has visited the US, and both countries have committed to negotiating a trade agreement, and specific safeguard actions I'm not in a position to comment. I'm sure Commerce Ministry and other relevant ministries are already working on it. And more importantly, it is not enough just to focus on the fact that the trade tariff measures are dominating headlines, but correspondingly, we're also seeing, for example, the crude oil prices are behaving quite well from the Indian perspective. So, and the crude is about $7, which is international benchmark as far as India is concerned. And if in the wake of any possible end to the war that is going on in Ukraine, and if more crude comes into the market, then I think the lower energy prices can very well offset whatever trade-related impact that may be there, which is at the moment speculative in nature. Now, when we spoke about the slowdown in manufacturing, I don't think I would have just mentioned this one single factor as the most important reason for India's manufacturing slowdown. Possibly, one is, of course, the Indian corporate sector cites demand visibility, which is actually endogenous in nature. I mentioned that as well. So now, again, talk about whether the additional trade actions by the United States on other countries will it result in additional dumping, and what it will result, what it would mean for output growth. Again, we are getting into speculative territory. As I said, these uncertainties will be with us, but there are offsetting factors which we need to focus on as well. Next question, please.
Tarun Sharma from Z Business.
Yeah, hi sir. Good evening, sir. I have two questions. So one is on the Kumbh side, sir. You mentioned about the Kumbh. So could you elaborate how its impact on the GDP? And secondly, sir, you have mentioned about the markets, sir, especially the stock market. Do you see only the US is the factor where we are seeing the downfall in the equity market, or is there any other factors which also impacting the stock market, sir?
Look, I'm not. It's been a while since I stepped out of my shoes as a global capital markets strategist, so I'm not going to get there. I simply said we wrote about it in the economic survey as well, and I said that this is an uncertainty that we need to be aware of and keep in mind, and it will affect all countries. And I don't want to speculate on where the market is going to be heading, in particular. Now, as far as the Kumbh is concerned, I did specify the boost to expenditure, private consumption expenditure, that it would have given the amount of money spent on travel, food, accommodation, etc. So that is how it can. It is hard for me to put a number to it, but that is given the total number of people who travel to Prayagraj for the holy for the dip in the Triveni Sangamam, running into 50 to 60 crores, it will have a sizable impact on consumption expenditure in Q4.
Prakash Priyadarshi from ET Now. Prakash, please go ahead and ask your question. I think he's not there. We'll move to the next question. Surabhi from Business Today.
Good evening, sir. This is Surabhi from Business Today. Sir, my question was on manufacturing. It's been cause of concern, and it seemed to grow at about 4.3% this fiscal. So, how do you see it panning out in the coming quarter and in the current quarter as well as in FY26? And do you see a plan B to, to a scenario where private investment does not really take off, because it's something that we've been struggling with for the last couple of years? Thank you.
No, thank you for your question. No, we don't make a sector-specific forecast in terms of, but if you look at the overall manufacturing capital formation, I mean, you have the data with you. So the gross capital formation numbers have been picking up in the manufacturing sector. I mean, right now, if you look at the gross capital formation, they were as low as 9.15 lakh crores in FY21, and for FY24. These number has gone up to 15.1 lakh crores. This is the gross capital formation in the manufacturing sector, from 9.12 or 9.2 lakh crores to 15.1 lakh crores in the last 3 years. So it's not as if it's not happening. So there is data in front of you that tells you that gross capital formation has picked up in the manufacturing sector. And there is output growth as well. Again, to give you the numbers, output in the manufacturing sector, and I'm quoting in nominal quantities here, from about 117 lakh crores. In terms of output, it is 194 lakh crores. And in terms of the GVA growth numbers, from about 28 lakh crores, we're talking about 39 lakh crores in the last 3 years. I'm talking about FY21 to FY24 comparison. GVA going up from 28 to 39.2, output going up from 117 lakh crores to 194. Capital formation going up from 9.2 lakh crores to 15.1 lakh crores. So what are we talking about here? So I think we're talking about the share of GDP going down because GDP has been rising faster, but it is not as if the manufacturing sector has been stagnating. And if you look at the fact that capital formation has been rising in manufacturing as well as in mining and quarrying and also in the utility sector, etc. For example, gross capital formation in the utility sector has gone up from 3.45 lakh crores to 6 lakh crores in the last 3 financial years, from FY21 to FY24. So given all of this, I think the manufacturing sector will at least maintain its share of GDP, if not rising further. And also, I understand that the Ministry of Statistics is revamping the index of industrial production, etc., where the current index isn't even capturing some of the new items that the country is producing and exporting, which were not there 12 years ago. So I think both in terms of published data and both in terms of what's happening in reality on the ground, where our non-petroleum, non-gems and jewelry merchandise exports have picked up by about almost 10% in the current financial year, it doesn't paint a picture of manufacturing stagnation or not going anywhere. So actually, the picture is one of very good optimism based on these numbers that I've shared with you.
Next question is from R. Suryamurthy from the Telegraph. So he has requested me to read out his question. So the question goes like this. Interestingly, while the Q1 of FY2025 GDP growth rate was revised downwards by 20 BPS to 6.5%, that for Q2 of FY2025 was revised upwards by an equivalent amount of 5.6%. Given these revisions, the Q3 of FY2025 print and the SAE of 6.5% for FY2025, the GDP is implicitly estimated to grow by 7.6% in Q4 of FY2025. This is slightly on the higher side given the global uncertainties surrounding merchandise exports and commodity prices, which would affect corporate margins, as well as subdued prints for sectors such as electricity and coal for January 2025. Do you agree with this interpretation?
Thank you, Dr. Bashir, for reading out the question. We already answered it.
Next, Sapna Das from CNBC. Sapna Das from CNBC News 18.
Hi. Hi, sir. Good evening. Sir, you have already mentioned on the market's perspective and how this thingy has impact, etc., global uncertainty. But we would like to hear from you once again, if feasible, what is it exactly that you said on the stock markets? You said that, you know, one probably there's
Um, uh,
right now. And
Ms.
second question,
Sapna,
sir,
that's
is very
your,
small.
your line is
This
quite bad. I couldn't hear you well.
Sapna, if you switch off your video, then your audio will become better. Your audio is a little garbled. Now just switch off your video and ask the question again. Yeah, please ask your question again. I think she's having some technical issues. Sapna, we'll come back to you later. Please stay. Don't go away. And the next question is from Nikunj from Reuters.
Hi, sir. I have a longer term question, meaning I want your view for the long term. There's a report that came out today by the World Bank which says for India to become a developed economy by 2047 or a high income economy by 2047, we need a growth rate of 7.8% for the next decade, for the rest of the 22 years. So and they've said that going with business as usual, this would be difficult to achieve. So what do you think we need to do here to achieve that growth rate of 7.8% to become a developed economy by 2047?
Thank you, Nikunj. I think while this particular briefing is on the numbers for the third quarter and also a deeper dive into the numbers that have been revised for the last 2 years, when it comes to this particular question and the numbers, the economic survey that we published about a month ago and the one that we published even 7 months ago in July, both of these surveys talk about what we need to do in the medium term to get to a developed country status, whether it is in terms of energy security, energy affordability, MSMEs, deregulation, more importantly, physical and mental health skilling. All these dimensions have been covered very adequately in the last 2 economic surveys. That is where the answers are, as far as your question is concerned.
Sapna, would you like to ask your question now? Sapna Das from CNBC.
Yes, ma'am. Thank you very much. Good evening, sir. Am I audible?
Yeah.
Okay, great. Sorry to say this, but you mentioned something on the markets, and you said that, you know, at one point in time, our markets were parabolic, and now there's a lot of global uncertainty, and hence, you know, the impact of the US, you know, the way the US markets have been doing in their data points, etc. Would you mind, sir, considering our request to kind of reiterate what you had said, and then you also quoted Chris quotes. That's one aspect. Second, sir, just, you know, kind of echoing what my colleagues are asking, is 7.6 a doable number for Q4? Thank you, sir.
Look, I don't want to say anything more than what I already said, and we have covered it I said we talk about uncertainties, but as I said, I'm not a market timer. I said looking at the long-term prospects of the Indian economy compared to other places and looking at the historical track record of the Indian market. So one shouldn't be over-interpreting the near-term numbers. That is what near-term performance and the near-term volatility, that is what I say, in effect. Now, as far as the implied growth rate of 7.6% for Q4, I think we answered this question more than once. Yes, there are factors which are continuing from Q3, but there are incrementally at the margin, there are some good developments such as very significant pickup in government capex, the additional expenditure that we are seeing happening because of the footfalls in the Kumbh, and as well as the good export performance that we have been seeing. So I think in general, while the continuing quote unquote negative factors, which some of you have alluded to from the second and the third quarter, while they are there, they are not incremental factors, but we have incremental positive factors which are making a good case for this implied growth of 7.6% being attained in the fourth quarter.
We have the last question from Ashoka Mitran from The Hindu. Ashoka Mitran from The Hindu, please go ahead and ask your question.
Hello, am I audible?
Yeah.
Yes.
Yeah. So when I look at the when we look at the GVA quarterly growth rates, just the primary sector has shown an uptick. Both the tertiary and secondary sector, there is actually some slowdown. So could you explain why we are seeing a tertiary and secondary sector slowdown, sir?
Look, I mean, this is quarterly numbers in India are not seasonally adjusted, and we did say that there were some uncertainties with respect to manufacturing. There were some concerns, and in the second quarter, etc. And but the longer term picture is one of improved output and GVA, which I just now explained to somebody in response to her question. So, but on a quarter by quarter swings and fluctuations are that much difficult to explain because these data are not seasonally adjusted. If anybody in MOSPI is on the call, if they want to supplement my response, please, they're welcome to do so.
No, sir, you have covered it. So nothing more to suggest. I am Sanjay.
Okay, thank you.
Sir, so with this we come to the end of the briefing.
No, Dr. Bashir, in fact, to the gentleman from the Hindu who posed this question, in fact, what you see here with respect to the manufacturing sector, in terms of GVA in manufacturing, Q3 actually shows sharper growth year on year, 5.6% in nominal terms compared to 3.3 in Q2, and in real terms as well, it is 3.5% compared to 2.1% in the previous quarter. And the same goes for the tertiary sector. You have hotels and trade growing at 6.7 year on year. This is in real terms or constant prices compared to 6.1 and 5.4 in the previous two quarters. If you look at it in nominal terms, there is a growth rate of 9.8% year on year compared to 7.6 and 8.5 in the previous two quarters. And the same goes for finance, real estate and professional services and public administration, defense and other services. So I would like you to take a look at the statement 7A as well as 5A of the MOSPI press release. So there is if you are looking at sequential momentum, the sequential momentum is on the upside, both with respect to secondary and tertiary sector. This is in response to Mr. Ashok Mitra. Thank you, Dr. Bashir. Over to you.
Sir, we have one more question now because Prakash Priyadarshi from ET now, he's having some technical issues. So his question is, India has witnessed its second warmest February since 1901 as declared by the IMD. It also predicts that a similar trend could continue in the remaining months of 2025. How do you see this impacting the Indian economy going forward?
Look, I mean, global warming is a phenomena that is a global phenomenon, obviously, and if we are been experiencing rising temperatures, I think we also have been taking measures with respect to adaptation, and agricultural research is also geared in that direction. And the new program announced in the budget of Krishi Yojana, so for covering 100 districts, is exactly meant to make our agriculture resilient. And also, if you look at the economic survey, the chapter on climate and environment focuses on the importance of adaptation, whether it is in terms of rejuvenating water bodies, increasing area under irrigation, and in general also using energy efficiency as a means to ensure that we are able to maintain a certain temperature levels, whether it is in factories or households, etc., to be able to function productively. So this is something that we need to do this on a continuous basis, in not just in the coming years, but also for maybe a couple of decades or more. So this is a global phenomena, and the answers lie in adaptation investments and adaptation practices, both in factories and in households, apart from improving irrigation and concentrating our research on climate-resistant seed varieties, as we have been doing in the last several years. These are all the possible responses, and the journalist concerned should also take a look at the relevant chapter in the economic survey for more details. Thank you.
Thank you, sir. So with this, we come to the end of the media briefing, and I thank you for having taken out time from your very busy schedule at the G20 meeting, and also thank Mr. Sanjay, ADG Mosby, for having joined. And thank you, friends, for having joined the briefing. See you all later. Thank you so much. Good evening.
Thank you.